Paycom Software, a founder-led cloud payroll and HR platform built from Oklahoma City in 1998 that quietly grew into a $2 billion SaaS powerhouse with some of the best margins in enterprise software.
PAYC serves the mid to large employer market with a single database human capital management platform, the kind of sticky, subscription-based software that clients renew year after year, regardless of economic conditions.
Chad Richardson founded Paycom in 1998 with a simple premise: give businesses access to payroll software through the web, years before that idea had a name like SaaS or cloud computing.
The product breakthrough came in 2019 with Betty. Instead of HR running payroll, employees verify their own records before the payroll closes. Errors drop by around 90%. Clients love it and rarely leave.
In 2023, Richardson initiated a quarterly dividend, unusual for a high-growth SaaS company. It signaled confidence in durable free cash flow and provided an income component for shareholders seeking growth alongside capital return.
Revenue lands just over $2 billion annually. Roughly 85% is pure SaaS subscription, employers paying a recurring per-employee per month fee for access to the full platform.
The remaining revenue comes from implementation services and ancillary fees. Gross margins on subscriptions approach 85%, a function of the single database architecture.
The unit economics profile is exceptional. Gross margins near 80%, EBITDA margins approaching 40%, and free cash flow that funds dividends, buybacks, and product investments simultaneously.
The single database architecture is the structural differentiator. Competitors like ADP and Paychex often stitch together acquired modules that require constant syncing. Paycom runs every HR function from one data source.
Paycom initiated its quarterly dividend in 2023 at 37.5 cents per share, $1.50 annually. For a high-growth SaaS company to start a dividend this early is unusual and deliberate.
The yield is modest at roughly 1%, but the signal matters. It reflects confidence in recurring cash generation and aligns Paycom with institutional shareholders who require income alongside growth.
Workday dominates the large enterprise segment with deep ERP integration. ADP has unmatched market coverage and brand recognition built over 6 decades. Paylocity is the closest peer, another cloud-native mid-market HR platform.
The HR platform covers the full employment lifecycle: recruiting, onboarding, benefits, time management, payroll via Betty, and performance reviews, all in one database.
Every touchpoint runs on the same database. No integration middleware, no data reconciliation delays. That architectural purity reduces IT complexity for clients and creates the switching costs that make Paycom hard to displace.
Chad Richardson has led Paycom as founder and CEO since the company's first day in 1998. He is the largest individual shareholder, aligning his incentives tightly with long-term equity holders.
Richardson's critics note that Paycom's growth has decelerated as the mid-market becomes more competitive. His response has been new AI-enhanced automation tools and expanded platform capabilities to re-accelerate upsell revenue.
Paycom Software, $2 billion in recurring SaaS revenue, near 40% EBITDA margins, a founder who has never left, and a dividend signaling long-term confidence. The question: can growth re-accelerate in a competitive AI era?
The next quarterly results will test whether new client additions are recovering and whether AI enhancements are driving faster upsells, the two metrics that determine if PAYC's premium valuation remains deserved.
Paycom reported Q1 2026 revenue of $571.9 million, up 7.8% year over year. Adjusted EBITDA was $275 million, a 48% margin. Non-GAAP EPS was $3.15. The company bought back $1.06 billion in stock during the quarter. Full-year guidance was raised. This is Charged Alpha. I'm Hudson.
And I'm Lana. Paycom Software is a leading human capital management platform serving mid to enterprise businesses. Revenue comes almost entirely from recurring SaaS subscriptions. Paycom's core differentiator is its single database architecture. One system manages payroll, HR, talent, and benefits without third-party integrations. Clients use the platform for workforce management from hire to retire. Market cap is approximately $9.8 billion.
CEO Chad Richardson founded Paycom in 1998 and remains the largest individual shareholder. Richeson's strategy has shifted toward large enterprise clients, companies with 500 to 10,000 employees, where Paycom can displace fragmented legacy systems with its unified platform. The Betty self-service product, which empowers employees to verify their own payroll before submission, is the flagship automation differentiator driving client retention and expansion.
Paycom reported Q1 2026 revenue of $571.9 million, up 7.8% year-over-year. The company beat revenue estimates by approximately $9 million. Growth was driven by new client wins in the enterprise segment and cross-sell of additional modules to existing clients. Subscription revenue, which represents nearly all revenue, grew in line with overall results.
Non-GAAP EPS of $3.15 beat the estimate of $2.85 by 10%. Adjusted EBITDA was $275.4 million, a 48.2% margin. This is one of the highest EBITDA margins in enterprise software, reflecting Paycom's efficient go-to-market model and low marginal cost of serving existing clients on a shared platform.
GAAP operating margin was lower, reflecting stock-based compensation and acquisition-related charges. The gap between GAAP and non-GAAP margins is a recurring bear critique. Paycom's non-GAAP adjustments are significant. Gross margin remained above 80%, demonstrating the economics of a SaaS platform, where incremental revenue carries nearly zero incremental cost above client services and support.
The most striking Q1 action was the buyback. Paycom repurchased $1.06 billion in stock during the quarter, more than the total revenue in Q1. This represents approximately 7% of shares outstanding at current prices. Buyback-driven EPS growth has become a central feature of the Paycom story, as organic revenue growth moderates from prior double-digit rates.
Paycom raised full-year 2026 revenue guidance to $2.175 to $2.195 billion, a narrow range implying 9 to 10% full-year growth. Adjusted EBITDA guidance was reiterated near 48% margin, confirming management expects profitability to hold even as growth investments continue.
Revenue growth of 7.8% is a significant deceleration from Paycom's historical double-digit pace. 3 years ago, Paycom was growing at 15 to 20% annually. Bulls view the deceleration as a maturation of SMB cohorts, with enterprise clients now providing stable recurring revenue at higher ACVs. Bears view it as a ceiling on the addressable market for premium payroll software.
Analyst reaction to Q1 was mixed. The 10% EPS beat and 48% EBITDA margin were positives. The 7.8% revenue growth was near the low end of expectations, keeping mixed ratings from major houses. Most analysts have hold or market perform ratings on Paycom at current valuations. The consensus question is whether the enterprise shift can re-accelerate revenue growth meaningfully.
The growth deceleration debate is central. Paycom exited its SMB-heavy phase and is reorienting toward larger enterprise accounts. Enterprise clients have higher ACVs, average contract values, but longer sales cycles and more competitive procurement. Bulls argue enterprise momentum builds over 12 to 18 months. Bears point to 2 years of below expectations growth as evidence of structural ceiling.
The 48% EBITDA margin is the Bulls' favorite talking point. In enterprise software, margins above 40% are rare and typically command premium multiples. Paycom's margin reflects a mature platform with low customer acquisition cost relative to lifetime value. Bulls model margins expanding to 50% as enterprise clients layer on additional modules with minimal incremental cost.
The $1 billion buyback is the most divisive signal. Bulls view aggressive buybacks as the board signaling the stock is undervalued at current prices. A company that bought back more in 1 quarter than it earns in revenue is making a massive statement. Bears view it as a sign management sees limited reinvestment opportunities, that organic growth has nowhere productive to go.
Valuation is the constraint. At 22 times earnings and 4 times forward revenue, Paycom is not cheap for a company growing below 10%. Growth at any price investors want 15+% growth for a premium SaaS multiple. Value investors appreciate the margin and buyback but cannot pay a SaaS multiple for a growth rate approaching single digits.
The bull case is enterprise reacceleration. Paycom is displacing legacy payroll systems at large companies, a market where ADP and Workday have aging architecture. If Paycom converts enterprise wins at scale, revenue reaccelerates to 12% by 2027. The single database architecture is a real differentiator in complex multi-state payroll environments.
The margin and buyback math compounds favorably. At 48% EBITDA margin on $2.2 billion in annual revenue, Paycom generates over $1 billion in annual EBITDA. Aggressive share repurchases deliver EPS growth of 15 to 20% annually, even at single-digit revenue growth. Bulls model $15 of EPS power by 2028.
The Beti product creates a retention moat. Beti shifts payroll verification to employees, reducing employer-side errors by 60 to 70%. Clients that deploy Beti rarely churn. High retention SaaS compounds over time as new wins layer onto a durable installed base without increasing service costs proportionally.
The bear case starts with growth deceleration. Revenue at 7.8% is well below the 12 to 15% that justified Paycom's prior premium multiple. Enterprise sales cycles are 18 to 24 months. Each win is hard-won. If enterprise penetration disappoints, Paycom faces a revenue ceiling near $10 billion market cap without multiple expansion drivers.
Competition is intensifying. Workday, ADP, and Ceridian have invested heavily in their own self-service payroll products, directly targeting the Beti differentiator. Workday's acquisition of Eightfold and ADP's Lyric platform are explicit responses to Paycom's architecture advantage. Large enterprise clients have procurement teams that run extended competitive evaluations, creating multi-quarter risk for each deal.
The GAAP versus non-GAAP gap creates valuation ambiguity. Paycom stock-based compensation is a real cost borne by shareholders through dilution. Bulls use non-GAAP EPS to evaluate the business. Bears use GAAP metrics, which produce a materially higher effective PE ratio. The buyback partially offsets dilution, but the net effect depends on management's cost of capital assumptions.
The buyback signal is double-edged. $1 billion in buybacks in a quarter where revenue grew 7% looks like capital returned because organic investment opportunities are limited. If Paycom's addressable market is reaching saturation in existing verticals, buybacks maximize shareholder value short-term but do not solve the underlying growth problem.
Workday is Paycom's most direct competitor in the enterprise HCM market. Workday serves Fortune 500 clients with comprehensive HR, finance, and planning software. Workday's 40% market share in enterprise HCM creates a durable competitive moat, but also limits remaining white space. Workday's growth is decelerating toward the mid-teens, providing a benchmark for what Paycom's enterprise ambitions face.
ADP is the market leader in payroll processing with over $40 billion in annual revenue. ADP's scale and brand are defensive advantages in mid-market payroll. Paycom's Beti product was designed explicitly to differentiate from ADP's employer-managed payroll model. ADP is investing in its own employee self-service capabilities, but Paycom's single database architecture is genuinely harder to replicate on ADP's legacy infrastructure.
Ceridian, now operating as Dayforce, is the closest pure-play payroll and HCM peer. Dayforce targets a similar mid to enterprise market with a unified cloud platform. Ceridian trades at a slight discount to Paycom, reflecting slower EBITDA margin expansion. The Dayforce versus Paycom competitive dynamic in enterprise sales is the most direct proxy for testing Paycom's differentiation thesis.
Paycom trades at a discount to Workday, roughly 20 times earnings versus Workday's 30+, reflecting slower growth. Against ADP at 15 times, Paycom commands a premium for higher margins. The bull case is multiple re-rating as enterprise wins accelerate. The bear case is continued compression toward ADP's multiple if growth stays below 10%.
Paycom's options market ahead of Q1 reflected moderate implied volatility. The stock had underperformed the software sector in recent months, dampening call positioning. Pre-earnings activity was cautious, with puts and calls balanced near the money. The 10% EPS beat provided an upside surprise, but muted revenue growth kept the post-earnings move contained.
Post-earnings options activity shifted toward call buying above current levels as the buyback news generated interest among yield and value investors. Near-term calls are positioned in the $170 to $180 strike range. Bulls targeting a re-rating buy calls, implying 25 to 28 times non-GAAP EPS, significant upside if revenue re-accelerates through 2027.
Insider activity at Paycom is notable. Founder and CEO Chad Richison has historically sold shares through 10b5-1 plans while maintaining a large ownership position. No significant open market insider purchases were disclosed in the last 90-day window. The board's authorization of additional buyback capacity signals confidence in the stock's long-term value, even as individual insider transactions remain minimal.
The combined signal is constructive for patient capital. The buyback is the dominant signal. A $1 billion repurchase at current prices is a strong management vote on intrinsic value. Options and insider data are less decisive. The enterprise transition is the real test. 12 months of new logo wins will confirm or refute the bull thesis, regardless of buyback support.
Paycom reported Q1 2026 revenue of $571 million, up 7.8%, with a 48% EBITDA margin. Non-GAAP EPS of $3.15 beat estimates 10%. The company bought back $1 billion in shares.
Bottom line, Paycom is a high-margin HR software platform pivoting from SMB to enterprise. Bull case is revenue reacceleration through Beti automation and enterprise wins. Bear case is growth below 10% at a SaaS multiple. The $1 billion buyback is why bulls stay long.
Financial data and charts sourced from Financial Modeling Prep. Charged Alpha is for informational and educational purposes only. This is not investment advice. Always do your own research before making investment decisions. Thanks for listening to Charged Alpha. Subscribe and leave a review if this was useful. New episodes every earnings season. See you on the next one.
Ooh-wee-doo! That ticker tape starts dancing fast. A bull market thrill that's built to last. Dividends are ringing up the swing. Listen to that sweet ka-ching. It's a Wall Street swing. That fast-paced rhythm makes you sing. Yeah, the Wall Street swing.